Just last month, the Fed resumed cutting interest rates, a move widely anticipated to support the economy. But for retirees who rely on fixed income, it could mean some tough choices. To break down what this means for your retirement portfolio, I recently had Mike Martinez from the Pension Group here in studio for this sponsored segment.
NBC4 Financially Speaking is sponsored by Mike Martinez with the Pension Group.
Mike, thank you for chatting with us today. All right, in a nutshell, is it good news or is it bad news to see interest rates go down for someone who is currently living off their savings?
Well, certainly it's bad for those living on their savings because we're going to see a decline in interest rates. So those high yields savings accounts getting 5% are probably going to be more like 3% today. We're going to definitely see that. Someone that's living on a fixed income like seniors, they're certainly going to experience that. And, I kind of use an example, with someone that has a $500,000 portfolio. If someone's getting a 5% interest rate today, that's roughly $25,000 of income that portfolio generates without really any market risk. But if it goes down to 3%, then now it's $15,000. That's a $10,000 difference. So that's a huge difference for a lot of retirees.
That is significant. Yeah. Let's define that risk. Why are these rate cuts problematic for folks who have money in CDs or high yield savings accounts?
Well, certainly the last couple of years rates have been up high and people are getting to the point where they're starting to renew those rates and they're like, aha, I'm not getting that rate I was getting before. So how can people pivot or plan ahead? And there are opportunities today with individual bonds. Yields are anywhere from 4, 6 to 5%. And we're typically recommending a 3 to 7 year investment strategy, for those bonds. So as the Fed continues to reduce interest rates, Jerome Powell and the Fed, if you lock those rates in today, what's going to happen? You don't have to worry about what the Fed's going to do because you have that portfolio, locked in for you. So one of the things I really stress is individual bonds, or you could look at fixed annuities like MYGAs. And typically those MYGAs, range anywhere from 5 to 5.5% today. In fact, I have a client that has well over $7 million invested in the market, but he has half of it was sitting in CDs. And we start looking at these MYGAs, these 3-year, 5-year fixed rates of returns by several well-known insurance companies, and we're able to find a much more competitive rate compared to the CDs today. So again, there's definitely opportunity, but timing is really everything. And
we have heard that falling rates usually cause bond prices to go up. How does that bond math work?
Well, certainly, once you're locked into those bonds, those, shorter term duration or intermediate, if you will, if you think about it, when we were in 2022, interest rates went sky high. But if someone had a 3%, yield, no one wanted to buy 3% when it was 7. Now the opposite's happening. Maybe you have a 4, 5, 6% interest rate. I have a client just a couple years ago locked in at a 7% rate of return. He's locked in. He doesn't have to worry about what the Fed's going to do. So as interest rates decline, there's an appreciation of value on those bond portfolios.
Should retirees watching right now, should they adjust their fixed income strategies?
Certainly now more than ever, because we know for one thing the Fed will continue to reduce rates. So don't be like a camel and put your head in the sand. You need to be proactive. You need to be thinking and some of those CDs or those money markets maybe aren't as favorable anymore. What are some of those other alternatives? And we've already discussed some of those.
So it's about having a plan that is resilient enough to withstand whatever changes come.
Well, certainly. And if we can lock in that for a 3 to 5 year period, and if interest rates continue to go down, you're not affected. And the overall objective for a lot of seniors today is to make sure that they have the income they need to pay for the essentials and more.
How can folks watching right now get started with you and a new strategy looking forward?
Well, there's one of the things on our website at thepensiongroup.com. They can take a retirement quiz, see maybe one or two areas they need assistance on. That retirement quiz is free of charge. They can go to our website, certainly they can give us a call to set up an individual meeting to review their situation. It's all about timing. I can't stress the importance. Timing is everything, especially now with the Fed continuing to reduce interest rates. Just a few weeks ago, and several more rate decreases projected, throughout the end of the year and into the new year.
And And Mike, I understand you have an added incentive for Columbus Living viewers.
Well, one of the things we do, I published a book many years ago, but Retire Financially Free. We'll get them a free copy for those that call in now to learn, the tricks when it comes to retirement planning, and certainly if they schedule a time to meet in office, we give them a complimentary consultation.
Thank you so much. Always a pleasure to have you on with your great financial advice. Mike with the Pension Group. The number is on the screen, 614-414-3568.